Good evening. This is the Angry Capitalist recording the Angry Capitalist podcast. I trust this finds you well. In this video, I'm going to be talking about a financial strategy which I'm very intrigued with. And the reason I'm intrigued with it is as of August 2024, we're now looking at least in my lifetime, higher than historical interest rates. Now, before you crowd into the comments, yes, I know that historically speaking, on a wider scale, uh, current interest rates really aren't jack shit. They're not really that high in a broader historical sense, but at least since I was a kid, interest rates as of right now are pretty decent. Before I get into it as well, please note that everything that I'll be covering within this video is purely for educational and strategic purposes. Fundamentally, you are your own individual. Take accountability for your own actions, do your own due diligence, your own further research on this, and where applicable, speak with someone licensed who can give you more in-depth and more accurate guidance. This is purely for strategic as well as educational purposes. Take everything I'll be covering within this video in context, and if you so decide, go ahead and employ this strategy, but make it make sense for you and your situation. All right. So what I'm getting at with this strategy is laddering. Now, it's a strategy that's used for fixed income assets. These could be things such as CDs, corporate bonds, municipal bonds, so on and so forth. Now, the purpose of this strategy is really just to meet or beat inflation. We'll try to also ensure that you have some access to liquidity on a revolving basis. So the way it would work is you use a fixed income instrument, which would mature, and you'll reinvest that on a regular schedule. This is typically done on a monthly basis. You can spread that out a little bit more if you want, but usually you're going to go ahead and reinvest on a monthly basis. Now, with these instruments, the maturity on that can be anywhere from 3 months to 6 months to a year plus. Typically, from what I've found so far, you wouldn't often be going outside of a year for the maturity on this. This strategy would typically utilize a shorter time frame. And the reason that you would do that is that you want the flexibility to adjust and to take advantage of changing market conditions and new opportunities that may arise. Which specific time horizon you decide to select can depend on a few different factors. These can include everything from how volatile you expect markets to be, the likelihood of a pending correction or recession, as well as the trajectory of interest rates. So what I mean by that is, do you expect interest rates to increase, hold steady, or maybe even decrease? As of August 2024, interest rates have been holding steady. Various pundits expect to decrease, but they've been talking about that for, almost a year and a half now, maybe 2 years by this point in time. I'm not going to hold my breath for a decrease on interest rates. It also doesn't look like they're going to increase anymore at this point in time. This is something that you have to go ahead and evaluate for yourself and make your own decision on. Don't trust anyone else's input on this. Do your own due diligence. What do you think they're going to do? Likewise, there is also a cost or an opportunity cost. So where else may you want to deploy your capital? If you're putting this into a fixed instrument, you may be losing out on potential gains in other markets. That's something that you'll have to look at as well and compare and contrast that to your own risk profile. is well likely the current market conditions you're expecting to go through or are currently in. To make this make a little bit more sense, I'm going to go ahead and give a more in-depth example. So picture for a moment that each month you go out and you buy $1,000 CD, corporate bond, or a treasury bond, and this bond has a 6-month maturity on it. So August, go out and you buy $1,000 CD or bond. September, you go buy $1,000 CD or bond. One sec. And you'll continue to go ahead and do this month after month. Now, after 6 months has passed, your first instrument from back in August will have matured. At this point in time, depending on what you want to do, if nothing has changed, you could go ahead and reinvest that principal plus the interest you got on it. Now, here we start to see the ladder, so to speak, looping in on itself, right? If you decide to loop the ladder, you can actually go ahead and create a snowball effect. So for anyone who's more familiar with dividend investing, as an example, if you put $10,000 into a portfolio of dividend-paying stocks and ETFs, and then each month or quarter they pay out a dividend, that interest can then be reinvested, either automatically or at your own time preference. You can start to see how if you just let this continue to compound and roll over time, provided interest rates are paying a decent amount, you can see how this could really grow a fund over time. Now, should an opportunity arise, the most direct way to go ahead and take the cash out of this fund is, and the most advisable, is just to allow them to naturally mature while you prepare to move on that opportunity. You may already be thinking, yeah, but if there's a massive stock market correction or downturn, I can't pull that money out of there immediately, at least not without some kind of penalty. So why does that make sense? I believe that lack of liquidity in this system can actually be a feature and not a bug. Now, if you bear with me, by not having access to that capital immediately, this can force an investor to be a little bit more prudent and strategic when redeploying it. So, for example, if you have the opportunity come up to buy a multifamily property, or to buy a privately owned business, or likewise if there's some kind of a possible correction in the stock market, being forced to wait a bit can make you slow down, be prudent, and really go ahead and get your ducks in the row before you redeploy that capital. A few notes on that. If you're going for something like more of a harder asset or something that's not listed on an exchange, such as a multifamily property or a privately owned business, those certificates that you will have, whether they're a PDF that's sent over to you or something that you physically sign at a bank or other financial institution, those certificates should be able to act as proof of funds. So if you're going to speak with a banker to get pre-qualified to buy a property, or if you're trying to speak with a buyer about it and they want to see some proof of funds, just like how you would say, hey, here's my bank statement, you'll say, hey, here are my CDs, or here are my certificates for this CD or bond. They're going to mature within our closing time frame. So let's say, for example, you set a closing date on a property and it's 6 months out. Hey, everything I have from this point in time until we close in this deal will have matured, and by that point in time, I'll have the cash on hand. That's something you should go ahead and bring up to them as part of your deal-making process. Likewise, though, if there is some kind of a correction in the market, rather than dumping everything in all at once, if you want to move into a correction and pivot, let's say, into buying some stocks or ETFs, what I would like to do and what would go along with this strategy's idea, once again, this is strategy, adjust this to your own situation, is simply buy as these instruments mature. So with these instruments maturing each month buy into the market a little bit more if you're going into a stock, an ETF, or what have you. There is that restriction on liquidity. It is a concern that you do have to take into account when it comes to whether you decide to choose this strategy or not. That being said, though, I do quite like it. And as of last month in July, I've gone ahead and started this myself. Next week, as of August 20th, 21st, I'll be going out and picking up another CD. It's a very interesting strategy. I think a lot of really large funds out there may even use this. And it's just one of those things that on the surface, it isn't sexy. It isn't super cool. It's kind of on the surface, it even seems a little bit lame for myself, who's primarily a dividend investor. Where I think it may become very cool and interesting, though, is if you decide to pivot this into private debt, which is way more risky. Once again, not recommending this. Do your own diligence, take accountability for your own risk. But you could effectively become the bank, so to speak, by lending out money on a private basis. Let's say you have entrepreneurs that are looking to raise capital. After your company, I don't want to own any of it. I'll go ahead and go with a fixed rate of interest. So I'll lend you, however much. And after a year's term, you'll repay the principal plus 6, 8, 10%, however much you can get that makes sense. Of course, in that situation, if you're going to be the bank, you have to do some bank quality due diligence. So take accountability for your own risks. But if you go typically with something more like a certificate of deposit, most commonly, if not always within the US, have insurance on them. Same deal with treasury bonds, although it's not 100% risk free. They're typically seen as very low risk assets to own. The biggest risk that I want you to be aware of, or the two biggest risks, if you're going with one of those more conservative fixed instruments to own, is first off the opportunity cost, which we've covered ad nauseum, but also your capital can still be eaten into via inflation. So check the current rate of inflation and determine for yourself what you think that will be in the year ahead. As an example, right after all the money got printed during COVID, in that first 2 years, 2021, 2022, if I remember correctly, with all that money being printed, anyone with any sense knew that inflation was likely going to skyrocket, which it did. Case in point, we saw some banks that owned some bonds which had interest rates way below the rate of inflation, and no one wanted to buy those. That led to some problems for them. So take that very seriously into account. Do you believe that the rate of inflation is going to be excessive while you're buying and holding these instruments? So I hope you like this video, and I hope you like the strategy. I personally think it's very cool. Granted, I do get kind of nerdy about that sort of thing. If you have another specifically fixed income strategy that you've heard of or that you like, go ahead and drop that down in the comments below. Likewise, if you enjoyed this video, please do like and subscribe. And I'll try and attach over here another video that I've done that I think you may like and that you may appreciate. With that, thank you, have a good night, and take care. Stay angry.